James, you've talked about a holistic approach to real estate.
Yeah.
What does it mean?
So we've become very specialized, not just in real estate, everywhere, right? The example I use is there are surgeons that will operate on 1 inch of the inner ear only.
Yeah.
And while they can fix that 1 inch, perhaps we should consider the systemic things that triggered the issue in that 1 inch. Real estate's the same way. And it's very easy to fall into data, right? The stats and the decks and the way a property is presented, especially when you have an appetite to invest or you have an appetite to buy that home or whatever it may be. It's really easy to find the bias and the echo chamber that supports the action that you want to come of it. The holistic approach to real estate is looking at those 3 things: macro, micro, site.
Mm-hmm.
Real estate decisions for us are not about a particular piece of real estate that's defined by meets and bounds and what exists on it. That's part of it. But I want to know what's going on around it regionally, and I want to know what's going on in a macro level. And it becomes very difficult today with data points that will support or cut against any decision that you want to make. And we joked the other day about, I think it was with Dan, about, numbers don't lie. And I went, no, numbers absolutely can lie, right? Especially when you have that bias going in. So it is critical that you check that bias of what you are wanting to have come out of this evaluation or assessment on any particular piece, and you check political bias. You check all of it at the door. You truly have to go in neutral and say, okay, what are the macro things that are happening? Where is consumer confidence? Where is policy at a federal level, then a state level, then a city level? All of that matters. Where are interest rates? Where are the job reports? What are the factors that feed into those numbers? My business typically reports 3 quarters after reality happens because it's a long burn. We're not stocks, right? You don't press a button and it happens. You have to find the piece and you draft documents, and they go to counsel and they're reviewed and there's diligence and all of that stuff. By the time you get to a closing and it records, you're quarters past the event. So for us, looking at the macro, 2006, I sat with my business partner at the time, and it was in the summer, and I said, it's over. It's over. We had seen all of the things leading up to it, but in the moment, in the hype, in the news, in all of the discussions, in all of the trade shows, everywhere, it was we're rocking and rolling, and we saw, oh no, enough of the fundamentals have gone awry at this point. So let's make sure that we're ahead of what's going to come next.
Yeah.
2 years before rates went up, we had predicted rates would go up and why. What were the factors contributing to it? To the month or to the quarter, we predicted September would be the first rate cut. There's no crystal ball, right? And you're never going to be 100%. But when you look at the macro, micro, and site through a non-biased lens, you can really get ahead of this. And when you can get ahead of it in real estate, you win. You win. Because in the moment, your peers and people that are in the business, it's crazy to me that we go through these cycles every 8, 10, 12 years, right? Rates go up, inventory, pricing, the whole thing starts to kick off. It's like everyone forgets. Some of the younger team that works with us, as we were coming out from this last once in a life event, which I've been through 4 at this point, right? COVID was our 4th one. And they were talking about, well, as rates went up, banks will never be doing 95% financing again. They'll never be 100% financing. And I said, wait, watch, right? The cast of characters change, but that fuel and the banks are competing to grow, and that appetite, all of those factors inform what's going to happen next. So for many years, I'll give a couple of examples on the podcast. we were talking to multifamily investors. And this is when, in my industry, doors was the big thing. Oh, how many doors do you have, right? When you peel that back, you start going, oh, you own 1% of 1,000 doors. Different than you're a GP operating 1,000 doors.
Yeah.
And you own 50%, right? Everyone was so hyped up and interest rates were low for so long that it felt like you couldn't miss. Rents were going up and interest rates were holding. And because we're in this period of appreciation in real estate, so many of these decks were predicated on value is going to increase. We're going to cut expenses 30% in a market we never operated in, by the way. We're going to raise rents at their continued trajectory. We're going to do all of these different things. And what we're buying today is going to be worth this tomorrow. Okay. COVID hit and the government starts to pump money, which it had to.
Yeah.
7 trillion, I think was the total number.
That is what it was, yeah.
Okay, so if you put $7 trillion in an economy, inflation has to occur.
Yeah.
So for us, it was a great opportunity to stack hard assets like land, because it's certainly going to outpace the other things that we were doing, and we weren't going to leave it in the bank because there you're losing money as inflation moves on. But at its core fundamental, when inflation rises, so do rates. Now, if you're speculating on multifamily and you're only taking 2 or 3 year debt and you don't have what I call room to get to the other side of the rainbow, we knew when rates went up and the money that was put in the banks starts to decrease, right? Banks can only lend a certain percent of what they have on hand.
Right.
So as that money went in, banks want to grow. So those small and mid-cap banks lend. When the other shoe fell and rates started to go up, those deals didn't pencil anymore. And a lot of the pushback was, yeah, well, we won't make as much then. And as respectful as I could, I tried to explain, no. You haven't been through this before. It's not that you're going to make less. It's that your debt is going to come due. And even if you're performing and making payments, there's nobody to renew your debt, because all the small to mid-cap banks that were in that world were out of charter because the cash kept dropping, right? They put the money in and we all didn't take it and invest it. A lot of people used it to live.
Yeah.
Deposits are dropping. Debt is still up here. Even with a performing note, this couldn't work. So what does that mean? That means that the big banks are going to sit on the sidelines, and these little things that you see when the big banks are offering an extra 0.25% or 0.5% to move $250,000 into their bank, that's macro, micro sight, right? I know that the big banks are going, we're not going to lend right now, but we're going to stock cash because then there's going to be an acquisition period. Last time around, it was a bailout with the banks. This time around, it was the bigger banks acquiring smaller banks. We knew some of the smaller banks had to fail, and that played out, right?
Yeah.
So when you know those things and you're connecting this holistic view, and you're not just looking at a deck, you're not just looking at a particular piece of real estate, you can really get ahead of it. We're not fortune tellers. We're paying attention. That's holistic real estate. It's looking at all of the factors without the bias of, because when you're in the moment and you're investing, you need to make that investment. You need to make that deal. You want to put that money to work, whether you're an LP or a GP, a little bit different mindsets, but you're looking for the reasons to confirm your bias that you're going to make this investment.
Okay, so let's talk then about the person who wants to be or is a real estate agent or a broker. Are they using a holistic approach, or are they just selling off the numbers?
Most sell off the numbers, and that's part of what I want to teach and how I won, because I was able to look at the other factors. And when you can, I certainly won't get into specifics, but there was an individual that was a builder who we had become very close with back in 2002, 3, 4, 5, made a bunch of money together, sold him a bunch of properties. And he had come to us shortly after the conversation I had about it's over. And he wanted to buy this next deal and said, hey, I want you guys to broker it. At this point, I was doing mostly brokerage, and business ethics. Couldn't do it. it was a big deal. Like it would have mattered back then.
Yeah.
And we sat down with them and we explained, hey, here's what we're seeing. Like we testified at the Senate in New York about these subprime mortgages, and we understand what really is happening here. You can't pay these numbers. We're going to hit a wall. The bias, he wanted that next deal. He was scaling. It was a step up in class. It was another 100 or 120 houses, another opportunity to bring another big project in under his belt. Couldn't do it. We stepped away from the deal and refused to be a part of it. He went through another broker, bought it, went bankrupt. Years later, we got the call. Wish I would have had more of an open mind and checked my ego and bias at that point, because I needed it to grow, right? And when you're in that mindset, it's hard to counsel a client not to pull a trigger on a deal that's going to put a lot of money in your pocket and potentially in their pocket, because we don't have a crystal ball. But agents, when they start to adopt that holistic approach, you really, really win. I hate to keep saying it, but it is the difference. You know, there's order takers and there's professionals. This is a different level.
Well, it's almost them taking the backpack off.
Yes.
To some extent. I mean, it's not the personal side, but the business side.
Yeah.
Right? So what happens then if you get to the next level? You get above the agent and you get above the broker, and now we start to become investors and developers, and the guys who have been there and the guys, I mean men and women who have been there and who believe they've seen it all. What do you say to those people?
COVID.
That's a good point.
I was through multiple cycles, right? The 2008 crash. Okay, that's a real estate cycle. It happens. Not always to that scale, but it happens.
Yeah.
Superstorm Sandy. Regionally, devastating impacts on real estate. Who would have thought that ever would have happened, right?
Yeah.
You're thinking, I've got to worry about hurricanes and half of Staten Island and Manhattan being underwater. These are realities. You know, when you're looking at these deals, especially if you're an LP, if you're a passive investor, I've seen great real estate go to hell with a bad operator. And I've seen terrible real estate shine like a diamond with the right operator. I think there's no replacement for experience. And what we look for is the narrative. Like, the story you're telling me is great. What happens when that story doesn't play out? Because in real estate, it never plays out according to script, ever. So when you're looking at these things and you feel like I've got it, you don't. You just don't know, right? Whoever would have thought COVID would have occurred and the impacts that would have come from COVID? Whoever would have built that into their pro forma, unless you're really trying to hedge, and you can only hedge to a certain point, but that's when it comes to the operator. Is this someone that has the tenacity, the grit, the experience, when you do get the curveball, to be able to not bail out of the box and make contact? That is the difference, man.
So all the things that you just talked about were acts of God, force majeure.
Yeah.
And when we talk about agent, broker, investor, developer, you got to plan for those too. Even though you don't know when the heck it's going to happen, you have to think about that. If this disaster happens, am I okay?
Yep. Not easy to do,
Yeah.
especially with leverage, right?
Great point.
So we're like the opposite of most investors. We're our money in first and only. And after we've got things where we need them to be, then we'll consider secondary sources to scale. It's another thing you want to look at is how much of the GP or the operating partner's actual capital that they're not deriving in fees through this deal is on the line, because it matters. You gotta have skin in the game.
Risk, yeah.
Right? You gotta have skin in the game. You can't protect against everything And again, it's why when you have those moments, it's not, oh my gosh, COVID hit, nothing I could do about it, right? We had a shopping center, a pretty big shopping center at one point in an area where COVID had a major impact. And we could have said, oh, COVID hit, what are we going to do? Or really double down, triple down, and lean in. And we operated that center every day. We engaged with all of our tenants. We worked through it. We got every tenant through the process. And we ended up with an asset at the end of it. When it was time to sell, people were looking, going, how do you have the payment history? How did you make it through this process? We have never been in a pandemic before, but we've worked with tenants that have had problems before, right?
Yeah.
And you work through those things, and it comes back. When you're persona non grata and something bad happens, and then you come and you ask someone to work with you, it's a lot harder than if you're vested from day one and they see your face and they've come to you with things along the way and you work with them. Business ethics, right? It all comes back to that. So there's no such thing as a bulletproof 100% opportunity in real estate. These markets, things happen, and you just need to make sure that your partners are experienced and, again, grit, tenacity, relentless, and will solve problems. That's what it's about. Whether you're an agent working with a first-time home buyer or you're working on a $100 million deal, you're solving problems. Same thing as an investor.
So we just got back from a little break here, and we were talking about macro, micro, and site. And then you talked about an experience that you had with your dentist.
Mm-hmm.
So can you kind of combine those? Because I think it'll really help people understand exactly what you're saying.
Sure. So it's not my current dentist.
No, right,
So
right, yeah.
but this was in the past, and at this point, I have had my share of success. I was a known, proven deal maker. And to the macro, dots, dashes to lines.
Yep.
I'm in the dentist chair, and my dentist is pitching me on a development deal in Florida. Now, on the surface, it's like, oh, Doc's talking to you about a development deal in Florida. The interpretation and the reality of it was, I'm the professional in that space. The equivalent would be if I got up and he got in the chair and I started working on his teeth.
Yeah.
Right? And it was this great deal, and the numbers looked wonderful, and the inducement was great, and they were going to make tremendous money, and it was all positive, right? Everything looked great on the decks. And I respectfully explained, you don't know a hammer from a backhoe, right? It's 1,000 miles away. You don't know anything about the micro, what's driving growth there, where the comps have been, average days on market. There's so many metrics that are real indicators of where things are going. Absolutely not. Like we had seen enough things at that point and connected enough dots to say, hey, there's a bubble down in Florida. Be real careful. Like, this is an absolute no for us, and I'd be super careful about money you put in and friends' money you put in. Because if you don't understand those bigger points, the site could be the best site in the world. If the macro is off and the micro is off, you're frozen in time. And real estate is a big ship, takes a long time to turn.
You bet.
Those down markets, 2, 3, 4 years before you start to pick up any kind of momentum again. Unfortunately, the deal went the way we had thought it would, but it was just an example of paying attention to the bigger picture and leaving that bias at the door. Everybody wants to make 20% on their money.
Sure.
Right? But the reality of it is, what else is at play?
Does that process start with something as simple as a home, going all the way up to land development?
Sure. I mean, the source of data is critical, right?
Mm-hmm.
Because there's always a bias, intended or not, there's a bias that applies to that source. When is a good time to buy? Well, for you personally, only you can answer that. But if it is a good time for you to buy, and you listen to the reports, understand you're a full year behind reality.
Because of the duration it takes to create the report and analyze the data.
For all of the comps and all of the process to play out, you're a year behind what's actually occurring on the ground. Again, it's how we're able to tell where rates are going, right? We look at stock market and other opportunities. The 10-year Treasury is where mortgage interest rates really trade off of.
Yeah.
And as you hear the news, recession and crazy and tariff in modern time, right? We understand investors are pulling from the market and moving to treasuries. As you move to treasuries and you're taking money out of the system on a government level, the country who's backing those treasuries doesn't have to pay the same rate, right? Supply and demand is at the core principle of every single thing in real estate. Every factor is about scarcity and supply and demand. So as money shifts, they can pay less because there's more people.
Yeah.
If you have 5 apples and 10 buyers, you could charge more. If you have 10 apples and 5 buyers, you have to charge less. Same thing, supply, demand, scarcity. So the more people who move to treasuries, the lower they drop the rate. As you're pulling money out of government spend, rates have to go down. Now, you won't hear almost anyone saying that, but I've been saying it leading up to September. 2 years ago, I said it would be in September because I knew election cycle, the Fed, right? All of these things. Either way, it broke. We knew that there was going to be a rate cut at that point. And one administration would have led to growth this way. Another administration would have led to growth that way. Different metrics. But we were so bullish on it at that point. You heard every debate, every news clip, president and vice president, candidate and candidate, cost of housing, cost of housing, cost of housing, cost of housing, right? It's become a real problem. Now, we know how hard it is to decrease the cost of a 2x4, right?
Yeah.
But something had to come of it because it's such a focus. The cost of housing is such a problem. There's millions and millions and millions of units that were short in the country. Again, paying attention to all those factors, we felt very confident, and I was very public about it on the podcast.
Yeah.
And people thought I was nuts, but to us, it had to happen. These next things have to happen. Regardless of my bias politically, one way or another, leave that at the door. These are the fundamentals that we see. These are the dots that become dashes, and enough dashes become lines. Eyes, ears, and instincts.